Aloha, and thank you for joining me for Java. This is for Tuesday, February 13th, 2024. There is quite a bit going on today after a relatively quiet day yesterday, so we'll get right into it. Starting with our favorite risk indicator, the MMRI, it is staying at a relatively stable level right at about 270, which is in high territory. But as long as it doesn't make any major rapid moves, I think the market is pretty good where it's at for a continuation. So, with that, today we are expecting data. We're getting CPI numbers prior to the market open, and those are potentially market moving. So, we will be keeping an eye on the 10-year yield, which did rise a bit yesterday, along with the relative strength of the dollar, which also rose a bit yesterday and put a bit of pressure on stocks towards the end of the day. So, starting off right now, we've got a bit of a mixed board, but as soon as we get those numbers, could cause a change. So, we've got the futures also kind of negative and showing a bit mixed with what's going on. Crude oil is benefiting from some of this. So, we've got stocks and bonds diverge as investors worry less about inflation. We'll see about that in a little bit here. So, we've got some earnings from companies today in our calendar. Notably, we've also got Coca-Cola, Shopify, Airbnb, which I'll be keeping an eye on, and Barrick Gold. So quite a bit here, but I just want to say a word on the company earnings. So basically, with inflation, when they report these earnings and they put these in with their balance sheets, the earnings for this year right now with the increased inflation looks larger than it really is because they don't do inflation adjusted. So when they report these, it's a bit of a bolster and not quite as strong as some of these companies will say. However, it will still move their stock prices, which as investors, that's basically the main concern for short-term day traders. So given that, we've got our calendar here showing we are expecting the CPI numbers. So that's everybody's kind of watching that. So yesterday we had crypto stocks. I was just talking about these, and I had given you the link to Gemini's in the description. If you want to get into a bit of Bitcoin, is the one that I recommend, or some other cryptocurrencies for that exchange. It's a simple way to begin for beginners. It's relatively easy platform. So Bitcoin hit over $50,000 for yesterday price in more than 2 years. So as I said, I think that's a little bit of inflation, but along with everything else in the market, people are looking for places to put their money. Also, it was disclosed that Pete Thiel, his founders fund, bought over 200 million in Bitcoin and Ethereum. So that gave it a bit of a boost as well. So if you don't know who Pete Thiel is, these are the companies that he's affiliated with: Stripe, Facebook, OpenAI, and Palantir Technologies specifically. So starting up these companies, a lot of high tech, and he's gotten into a lot of these. So that was a bit of a mover for that. So moving in, got a couple of people that are talking about shorting Bitcoin at this level. I would just like to urge a bit of caution on that. So while Bitcoin is at higher levels, it seems to be consolidating right about the 50,000 level, which means it's setting kind of a solid ground here for the next move. And it could do what Nvidia has done or other stock prices. So Nvidia now has surpassed Google, and Amazon is now the fourth most valuable public company in the world. So yes, this is deeply overbought. However, can run and go farther than you would imagine. So with this, there are some sympathy plays, meaning other stocks that are because of these major moves with Nvidia and in tech. Masayoshi Son added $4 billion to his wealth because ARM rallied 192%. So very impressive rally that ARM had. That, if you don't know what ARM is, it's a smaller chip manufacturer, basically. So they do support chips because they need more than one type. So SoftBank shares hit most overbought levels since 2003 because they're heavily invested along with ARM. So that was quite the run yesterday. So moving forward into basically commodities, we've got the IEA expecting comfortable oil markets and moderate prices for 2024. So basically, it says they are expecting the supply and demand to stay relatively stable and not a lot more price shocks, but at least they're not talking about constricting supply further. So, with that, I'd like to go a little bit into the commercial property loans coming due. So, this is a huge one for two major sectors. First, of course, real estate, but secondly, for the banking system, because the banking system carries all of these loans. And what has happened is maturities, meaning that these debts are coming due. So they will be forced. A lot of the banks have been holding off, waiting for the Federal Reserve to kind of cut rates, basically, so that they could get their loans rolled over at lower debt. So these numbers are relatively shocking. They've got nearly 20% outstanding debt on U.S. commercial and multifamily real estate that will mature this year. Most of them, the highest time frame is March and April, when they will be required to refinance these loans or sell the properties. So this is a lot higher than the Mortgage Bankers Association have given off before. So we'll see how this happens, but this is part of what brought down NYCBs. They've got certain banks, they've already got pre-chosen banks set up. They won't tell us, but they've got pre-chosen banks that will take these toxic assets that they're going to sell these loans to that they expect to default, let those banks either close or get merged or sold, and all of those loans will be purchased back by a larger bank for pennies on the dollar. And that's how they grow these mega banks. So we'll see more of that coming forward. We're going to have more merged banks, more closing small, middle-sized banks. So we've got another part of the banks failing is that they could also basically government backstop banks of their choosing. How did they do that? With tax dollars. So we've got US January deficit for the US Treasury is dropping sharply as receipts grow and tax refunds fall. Basically, what that means is they're taking more from people in taxes in the United States or those that are subject to tax from the United States funds. So a lot of people not getting refunds this year that expected it or having to pay a higher bill than they expected. So squeezing people out of taxes. So with this, we'll move on to the real economy and real indicators. We've got car loan delinquency rates. We were talking about this climbing to the highest point in 14 years. So people stop paying on things that are unsecured first, meaning primarily either these buy now, pay later loans that are not backed with anything. So if they don't pay these loans, then they don't have anything that they would lose from it. After that, they don't pay the credit cards. Once they stop paying the credit cards, they stop paying the car loans and get those repossessed. And then finally, the largest asset, which is homes, will stop paying loans and the mortgages. So globally, we're going over to the UK. They're talking about kind of same narrative they're putting out mainstream media in the United States. You'll recognize this. They say stronger than expected wages and wage growth bolstering the Bank of England caution, kind of giving them room to where they don't have to hike rates, but they're keeping the door open. So we've got the Swiss inflation slowing, opening the door for the Swiss National Bank to cut if they need to. So we were talking about this before, or if you're new here, the European banks cannot let the United States cut first. The US will have to wait and either cut at the same time or after, because otherwise they will decimate these other currencies, the euro or the Swiss franc, whatever it is. So moving on, we've got German home builders starting the year more pessimistic than ever, talking about construction dropping to a record low. So first, they're talking about the jobs, their manufacturing is down. Now the home builders are not able to build. So we've got an issue with that. In the meantime, they've also talked about Japan jumping the other way. They've kept a super easy monetary policy, and they are sliding there down. Now the world's fourth largest economy. They used to have a lot more strength in their manufacturing. So we'll see how that comes there, sliding behind Germany. So a little bit of a bolster. This story says as corporate America pivots to artificial intelligence, they're finding consumers rejected for loans and jobs. And what that means is a lot of these companies now, prior to you being able to speak with a human, they filter either your resume or your applications through artificial intelligence. And if you're rejected, humans never see it. So you don't have any type of appeal policy. So that could be a problem. We'll need some restructuring. Also wanted to bring this up. They're talking about sanction spreading. So this goes back to the currency wars. With China, they are now being sanctioned. They're talking about illegal sanctions from the European Union. So the EU is saying that China doing business with Russia, they basically want to cut them out and sanction them. And I think the tide will turn with that because they need China a lot more than China needs them, as well as Russian gas. So with that in mind, we've got Austria now, EU state, is getting 98% of its gas from Russia. They're completely dependent upon Russia to provide for them. So just as an example, basically OMV's company, they cover about 30% of Austria's gas needs, and they have signed a deal with Gazprom, which is the Russian company, that they will at least purchase a certain amount of gas from them from 2018 all the way until 2040. So they are bound to purchasing this gas from Russia despite sanctions until the year 2040. So that's not going to stop anytime soon. So with that, we've also got Iran. They are taking the market on steel production. So their productions have increased so much that they now account for over 58% of West Asia's total production of steel for the year 2023. So that's all of basically Middle East. And they are coming up, I think it is 6th or 7th in the world. So they're gaining traction rapidly. So a couple of lava updates before I let you go. We will have war forevermore for a couple of reasons. So we've got the European Union are now saying that they've got methods and they've put out legislation in order to use Russia's frozen assets that they have basically put in holdings, their foreign reserves, and they are seizing these assets and giving them to Ukraine. So the interesting takeaway from this is that they have said that they can estimate about 15 billion euros that they will give to Ukraine over the next 4 years. So that right there says that they have no intention whatsoever of stopping this war prior to the next 4 years. The other reason that they won't stop these wars, cannot stop these wars from the West, is that the United States, which is basically the one they're all leaning on, must use this war for multiple reasons. Number one, keep the GDP up because war boosts the GDP. And number two, to cover the inflation issues that are happening here. War is inflationary, but it also drives that. So as it slows down the financial issues that they're having and the underlying portion of it, it's also a way to export the inflation at a faster rate, watch other countries kind of spiral down, and they can recover or at least have this slow descent, basically back to a little closer to reality. So with that, I wish you all a great trading day, wonderful day in general. And until I see you again, my friends, stay free.